You ever watch a stock make a huge move and just wonder, how did the pros see that coming? Well, it's not magic. Turns out they're just following a trail of clues, footprints left by the biggest players in the market. And today, we're going to show you one of their most powerful tools for finding that trail, option volume analysis.
So here's the game planner. We'll start by talking about how to track what they call the smart money. Then we'll dig into what option volume actually is and its crucial partner, open interest. After that, we'll get into 4 key trading signals you can actually use and wrap it all up with a real-world example to see how it all clicks together.
All right, let's dive right in. The whole idea behind this technique is getting a sneak peek into what the big institutions, the smart money, are up to.
I mean, it's the question on every trader's mind, right? How do they always seem to be in the right place at the right time? Is it some kind of sixth sense? Is it just a lucky guess? Nope, not at all.
See, the secret is they're not guessing, they're following the evidence. These massive institutional trades, they leave behind these digital footprints in the market data. And one of the absolute clearest footprints you can track is by analyzing option volume. Okay, so if we're going to use this tool, we first need to get the basics down. We need to learn the language it speaks. So what exactly is option volume?
Honestly, it's pretty simple. Just think of it as a scoreboard for activity. If you're looking at, say, the 25,000 strike call on the Nifty index, the volume is just the total count of how many of those specific contracts got bought and sold today. That's it. It's a raw, direct measure of what people are interested in.
And this is where it gets really interesting. A ton of volume at a specific price? That's like a giant spotlight. It tells you that a lot of traders are focused right there, turning it into a potential battleground. On the flip side, low volume, that pretty much signals that nobody cares. It can also be a red flag for low liquidity, which usually means wider spreads and a whole lot more risk.
But here's the single most important thing to remember. A massive spike in volume tells you something big is happening, but it doesn't tell you what direction it's going. You can see the intensity of the battle, but you don't know who's winning yet. All it shows you is interest, not direction.
So you might be thinking, okay, if volume doesn't tell me if the price is going up or down, then why do the pros love it so much? What's the point of watching it so closely?
Well, because volume is our reality check. A price move that happens on high volume has real conviction behind it. It's genuine. A move on low volume, that could just be noise. More importantly, it shows us exactly where that institutional smart money is placing its bets. And when you know where they're active, you can identify the price levels that really matter, those key support and resistance zones.
Okay, so volume tells us where the action is. But to get a better guess at the likely direction of that action, we need to add a second piece to the puzzle. This is where we bring in another powerful metric called open interest.
You're going to want to pay close attention here because this is the real secret sauce. Think of it like 3 different scenarios. Scenario 1, both volume and open interest are going up. That means new money is flooding in, building fresh positions with serious conviction. Scenario 2, volume is high, but open interest is flat. That's usually just noise, day traders passing contracts back and forth. But scenario 3 is the big one. Volume is high, but open interest is falling. That's a rush for the exits. That tells you people are closing out their old positions in a hurry. You see? When you combine these two, the market noise suddenly starts to tell a very clear story.
All right, enough theory. Let's make this practical. Here are 4 key things you can look for when you're applying this analysis to your own trading. So how do you actually do this? First, focus your attention where it matters most, on the at-the-money options. That's where the action is. Next, you got to be a detective. Keep an eye out for those sudden, weird spikes in volume. They practically scream that smart money is making a move. Then, use that volume to confirm what you're seeing in the price. A stock breaking out without any volume to back it up? That could be a trap. And finally, a simple rule to protect your capital. If there's no volume, just stay away. It's not worth the risk.
All right, talking about it is one thing, but let's make this crystal clear. We're going to walk through a super simple, practical example so you can see exactly how you'd use this in a live market.
Okay, so picture this. You're watching the market, the Nifty index is just chilling right at 24,700, and you're trying to figure out where is this thing headed next.
Now you pull up the options chain. On one hand, maybe you see a massive surge of volume and rising open interest in the 24,800 calls. That is a loud and clear bullish signal. Traders are placing some big bets on a move higher. But what if you see that exact same activity exploding in the 24,500 puts? Well, that's the complete opposite signal. Big money is either betting on a drop or they're rushing to buy protection. In either case, the story becomes incredibly clear.
And that's really the perfect way to look at it. This isn't some crystal ball that predicts the future with 100% accuracy. Think of it more like a powerful magnifying glass. It lets you zoom right past all the noise and see the very clear footprints left behind by the biggest, most informed players in the game.
By learning to read volume and open interest together, you're not just guessing anymore, you're actually interpreting evidence. So the real question isn't what the market will do, it's what will you see tomorrow with this new tool? What secrets are out there just waiting for you to uncover?